Hi everyone, welcome back to Be Rich. It's me, Vinod, recording remotely from Abu Dhabi. Today I wanted to talk about what is happening globally in terms of macroeconomics, why we're living in some strange times, and how the world is shifting towards something I would call geonomics. Geonomics is the idea that using making what you call political maneuvers and using economic tools to get geopolitical and domestic political goals met. And the case in point is, of course, the US government bond market. You can see this in because the market forces would definitely be pushing the long-term yields up, but political maneuvers are trying to artificially control this. As always, in this kind of a scenario, when you have debt rising, right, and deficits rising, and risk premiums there, inflation and all this put together, most times we expect the long-term yields to raise faster than the short-term ones because of what's happening with the high levels of debt. And we can talk about this historically, we have seen this in the past. But if you see, currently this is being not the case so, because the current Trump administration has been trying to keep these long-term bonds and treasury yields down as much as possible through such things as Operation Twist. Some of you might be wondering, what is this Operation Twist? This is when the Fed issues short-term bonds, 1 to 3 year bonds, and takes the proceeds from that, and Fed itself buys the long-term bonds. That way pushing down and softening long-term bond yields. This has been done in the past. John F. Kennedy was the first one way back in 1961. Then, of course, recently Ben Bernanke also used it. So this is something which has a precedent. It's not something new. It's not something the Trump administration has invented, but it's something, a way to create, cheaper mortgage loans and business loans for the long term without actually injecting more liquidity into the market. So it's called bending the curve, and they're trying to actively do this. But what it's showing is that non-market actors are starting to influence the yield curve and weakening the independence of central bank. And this introduces a lot of uncertainty, not only in the short term, but even in the long term. Because no more are we following economic fundamentals that drive rates, which is how it should be, but political objectives are trying to be met by using economic maneuvers. And this is just not an American thing, this is a broader thing. Globally, if you see, more and more countries are increasingly bending economic, trade, financial, and security policy tools to take advantage of strategic goals. So, export control, weaponizing trade, reshoring, that means bringing things back, and industrial policies. All these, you can see the framework seems to be that this is a tool we're going to be using more and more. We were in a world during post the Cold War, I would say, where we were more liberal, we were more free on trade and policies, where we were setting up these global networks and we were working in, tandem with each other and cooperation with each other. But the world seems to be very clearly moving further and further away. And case in point is, if you realize the way the bond is moving and stocks are moving, it is truly a paradox, right? Both are hitting record levels simultaneously. Traditionally, the relationships have been, the rate goes up, stocks go down. Now the rates go up and stocks go up. And even today, case in point, when I'm recording this, the American S&P 500 has somehow hit new records and gone up further, considering the fact that the American government is in the middle of a shutdown. And that shutdown has more uncertainty mixed into it. There is no clarity on when this shutdown is going to get over. And even gold seems to be reflecting this. And gold prices are slowly and steadily going up. Yes, there was a brief correction, but these are expected, those corrections. And it is trajectory shows it is going further and further northward. So the world has fundamentally moved away from what we were known as normal. And a lot of us thought, before 1971, there were other currencies before World War II, which were the reserve currencies of the world. But what a lot of us fail to understand and realize and remember, that is before the Nixon shock, whatever was considered the currency of the global reserve currency, it was pegged to gold. Gold was always tied to it. So at the end of it, it was the gold which was the reserve currency. This anomaly only started happening since 1971 when dollar was unshackled or was decoupled from gold and gold was left alone, and that's what raised gold prices to the roof way back in 1971, and that has led to this fueling of gold. Us moving closer and closer to gold globally, and central banks, like I've said when I was talking in Instagram, are moving closer and closer to gold. You're seeing this happen with China. That we've seen it even in Singapore, where they're creating facilities to store gold and try to, create a secondary market away from London and the United States, moving more eastwards. So this idea of gold becoming more of a neutral reserve currency seems to be picking up steam. And this is not a trend. This seems to be something that is going to be with us for some time. I don't see us moving back to the world which we were in maybe 5-6 years back. We are clearly in a new direction, a new trajectory. And when you're investing in this kind of an environment, you should be really sure of what you're doing and be really clear on what you're doing, especially in these new environments. You cannot take old rules which we took for granted before. Like I said, when interest rates goes up, stock markets tend to correct, and when interest rates go down, stock markets tend to go up. All those seems to have left the window, and we are in a strange new environment where no matter what the news is, the stock market seems to be going higher and higher. So I wanted to highlight this as something to keep in mind as you're traversing the globe and you're trying to look for investment opportunities, be it in the US, be it in Japan, or even here in India. Wherever you are working and wherever you are earning and you're trying to secure your retirement and your investment, you should keep this in mind, that what we were considering as economic policies for economic needs are not anymore looked as policies for economic needs or economic needs. Sorry, we're not looking at economic policies meant for economic needs anymore. We're looking at economic policies as weapons which are being used for geopolitical scores that need to be settled. Case in point is also the Swiss franc. The way the Americans have managed to convince the Swiss not to lower their currency or dilute their currency, for the simple reason the dollar is getting weaker, the Swiss is getting stronger, the franc, and it's hurting the Swiss locally for their own exports. I do not know how long these kinds of negotiations will hold water anymore as we get further and further away from the world which we used to know. So I wanted to share this with you on the Sunday evening and give you some food for thought, and as a further explanation from yesterday's video where I was talking about the bubble in AI and what is happening there. I hope you found this video informative and entertaining as always. Tomorrow I'll try and have Anand back with me and we will discuss something which is more stock specific, hopefully, unless something interesting happens globally or macroeconomically. Thanks for being with me on Be Rich today. Wish you a wonderful Sunday, and I'll see you tomorrow with another one. Thank you.